Folks, today I'm going to do a three-part series. It's all going to be about income, and more income. Credit spreads, all right? We're going to talk about bull put spread, bear call spread, iron condor spread. All three. I sometimes confuse them, but we're going to talk about all three, and I'm going to explain to you why. Now, generally speaking, there's probably about 300-400 different types of spreads out there. There's the butterfly spread, the ratio spread, the modified iron condor spread, the double-legged frog spread. I don't know. There's so many different spreads, I can't keep track. But I've been doing this for over 25 years. And the only type of trades I do other than net option positions are credit spreads. Simple two-legged credit spreads. And sometimes I'll do an iron condor, which is just doing a credit spread on both sides. So I'm going to get into that in today's video. I'll start off by talking about a credit spread, and I'll explain it to you via example. And I'm not going to get into the Greeks. I'm not going to talk about implied volatility. I'm not going to talk about delta. I'm just going to keep it real simple, okay? So let's say that Amazon, all right? Let's talk about Amazon. Let's say Amazon is trading at 1950, all right? Probably not too far away from its price. It's probably somewhere right around there anyway. But let's say that I believe that Amazon is going to stay around 1950 and not really go anywhere. It's not really going to go much higher, and it's not really going to go much lower. It's going to be a two-sided market action for Amazon. It's going to go sideways. It's called two-sided market action when you have both the bulls and the bears, all right? And they're controlling the market equally. So, what do? You can't take a net position, you can't take a long position or a short position because you're not really expecting the market to go down. You're not really expecting the market to go up. You're kind of expecting this market or this stock to really not do anything. And the reason why I say the market is Amazon is highly correlated to the S&P 500. The correlation is about 90%, 95%. So if you see the stock market move up, good chances that Amazon will move up. And if you see the stock market move down, there's a good chance that Amazon will move down. But either way, they're correlated. So let's just assume for a minute that we want to take advantage of Amazon. We don't know which way it's going to go, but we believe the most likely direction is sideways, all right? Sideways, two-sided market action. So what we want to do is we want to create income. We want to make income from this trade. We believe firmly it's not going to go above 1950, and it's probably not going to go below 1900, but we'll get to that in a minute. So what I would do is I would like to sell an option, probably somewhere around the 2000 strike price. All right? Options have different strike prices. I'm not going to get into the basics of options because there's just so much to talk about, but I do want to explain how this spread is put together. So I would sell a 2000 strike price. Now, if I just do that, I could probably take about $1.50 in premium, all right? But if I do that, and if I'm wrong, and if Amazon skyrockets, I'm going to have unlimited risk. I don't want to have a limited risk. I don't want to lose my ass, excuse my French. I want to be hedged. So what I'll do is I'll sell the 2000 strike price and I'll buy the 250 strike price. So worst comes to worst, Amazon goes to 2500, okay? All right? Jeff Bezos remarries his ex-wife and all his legal troubles go away and he makes another $1 billion and Amazon goes to 2,500 and I was dead wrong. It could happen. The difference, my risk will be the difference between 2,000 and 2,000, $2.50. So my risk is $2.50. Now, when I sold this 2,000 strike price call option, it's a call, I took in $1.50. And when I bought this strike price, I had to pay, say, about 65 cents. All right? So my net income is about 85 cents if Amazon does not rise up to the $2,002.50 level. And now it's at 1950. And here's the thing. In order for this credit spread to work, in order for us to buy and sell these two options, they have to have the same expiration dates, and they have to be both calls. If one is a put and one is a call, it doesn't work. So what we're doing is we're selling an option where we don't think the stock will go. We don't think the stock will go to 2,000, and then we hedge ourselves by buying an option that's substantially cheaper. So in this case, the 2,000 option was $1.50. We put that in our pocket. That's ours to keep. The debit that we had to pay for the hedge, the $2,002.50 hedge, was 65 cents. So our net was 85 cents. Now here's the kicker. If Amazon does not go up to 2,000 by expiration date, and usually we sell these options about 2 to 3 weeks in advance. So if Amazon doesn't rise by about 50 points over the period before the option expires, we're going to keep this 85 cents. And our total risk is $2.50 minus the 0.85 cents. So in the scenario that Amazon does bolt, we would lose $2.50 minus 85 cents. And I believe that's $1. Let's see here, $1.50, 35, that's $1.65. So our risk is $1.65, our profit is 85 cents. We get the profit up front. Worst case scenario, I'm dead wrong on the trade. It happens about 20% of the time. We'll lose $1.65 because we get to keep the 85-cent premium. So again, just to review credit spread, you initiate a bull put spread, you initiate a bear call spread. We'll get to the bull put side in a second. You initiate a bear call spread when we believe the stock market has topped out or the stock has stopped out, or both. The stock and the stock market has topped out, assuming it's a highly correlated stock to the stock market. In this case, Amazon is at 1950. We believe it's not going to go up above 2,000 before these options expire. Usually we sell options that have a couple of weeks left. In this case, we sold the 2,000 for $1.50. We bought the $2,002.50 as a hedge for 65 cents. We got a credit of 85 cents. That 85 cents is ours. And when you buy a contract, you buy 100 shares. So that would be $85 per contract. And again, worst comes to worst, we're not naked. We didn't just sell the 2,000 and expose ourselves to unlimited risk. We hedged ourselves by buying the $2,002.50 contract. So our risk is the difference between $2,002.50, which is $2.50, minus the premium we received. So our credit that we keep in our pocket in this case is $1.60. I mean, the worst case scenario, we give up $1.65, which is the premium minus the income that we received. And the situation, the scenario that'll happen is about 20%. About 80% of the time, we'll keep our premium because options are decaying assets, and the probabilities are that this option or this stock will not bolt from 1950 to 2000 before expiration. In the next video, I'll talk about bull put spreads. I keep confusing bull put spreads and bear call spreads because I put them on at the same time usually, which creates an iron condor, and I'll get into that in the third video. But this was a bear call spread. You put on a bear call spread when you're not expecting the stock market to rise any further, or just expecting the market to move sideways, which is called a two-sided market. Please subscribe to this channel. I really want you guys to subscribe to this channel. There's going to be a lot of info here, a lot of actionable trading tips that you can use. Please subscribe to the channel, and I'll see you in the next video that will get into bull put spreads.